Okay, on today's episode of the Investing City podcast, super excited to have Yaron Naymark on. So thanks so much for being here.
Thanks for having me.
Great. So I think it'd be awesome to start with a little bit of background and just tell us kind of how you got to where you are with managing One Main Capital.
Yeah, so my background goes back to me being a very young kid. Is kind of when I got interested in business and investing. I grew up to small business owner parents who moved to the States a few years before I was born, and they had, a small little store selling towels and bathing suits and stuff like that to tourists in South Beach. They had friends who had much larger businesses and family members who had larger businesses, some of which eventually got sold to private equity, some of which are still being owned and operated by the families today. And I still remember when I was a child and I was a kid, after dinners, kids used to get up and go play, and I used to sit back and listen to all the conversations they were having at the dinner table about hiring decisions and growth capex decisions and working capital management. And I think what really drew me into those conversations was I grew up with kind of very modest means as a family, but some of those friends who had the larger businesses achieved, financial independence, tremendous financial independence at a very young age, without college educations, without formal training in anything other than business. And I was like, drawn to that. I thought, wow, I want to figure out what they did. And so I would just listen to those conversations. I started reading, the Buffett letters and Seth Klarman letters and all that kind of stuff in high school and college. And, I wanted to eventually find a way to get into business. I didn't really know what my career path or options were. Having grown up away from the Northeast and to people who never were college educated, I just was not exposed to private equity or hedge fund. I didn't know what any of that was, but I started doing some reading about career paths while I was in college, learned about investment banking, and decided that would be a good place to start my career, to really learn about business and be exposed to, business people who were a little more refined and, who I could learn from. So made my way to New York, started my career at Citi, and eventually moved to the buy side, worked for a private equity firm for almost 3 years, and then moved over to the long short equity world for probably 5 or so years. And then, the last fund I was at shut down, and, I started One Main Capital in early 2018, so a little over 4 years ago. I started the fund with very little outside capital. It was my personal capital, pretty much my entire net worth. And some of my former bosses gave me some, here you go, we believe in you type capital, but nothing meaningful. And, I'd never run a portfolio before. I'd never managed risk before. I was just kind of a stock picker in my prior jobs. And so I spent the first few years not really marketing the strategy, but just, kind of refining the process and making sure it works and building confidence in myself. And over the last few years, have really started kind of marketing the strategy. And, that's where we are today.
That's awesome. So I noticed you said you were kind of just a stock picker, hadn't managed risk before. I think it'd be awesome just to talk to that a little bit of what are some of the major differences with actually, becoming that portfolio manager and managing the risk versus just picking stocks.
Yeah, I think, a good portfolio manager is also a good stock picker, but a good stock picker is not necessarily a good portfolio manager. Stocks are idiosyncratic bets on the fundamental value of businesses, or that they should be idiosyncratic. And there's a lot of things that could make multiple stock bets not idiosyncratic. They could be very correlated to each other. They could behave very similarly in times of stress. And in terms of what the expected value of that bet is, it could be a pretty attractive bet, but from an expected value basis, but the range of outcomes could be very wide. And, the downside for that wide range of outcomes could be really high. It could be really low. So I think a good portfolio manager is good at finding, good risk rewards, more broadly speaking, and is good at constructing a portfolio of those good risk rewards in a way that behaves well through various economic conditions, because none of us know if over the next 5 or 10 years interest rates are, if they've hit a low and they're about to trend higher, or if they're going to continue kind of that secular trend lower, maybe stabilize here. None of us know whether the economy is going to be super strong or average or abnormally weak. None of us know if, there's lots of things we don't know. And I think constructing a portfolio that could do well in all those different types of environments instead of riding a single factor, I think is a skill that's valuable. I don't think it's a skill you can prove that you have over 4 years. So I'm still cognizant of the fact that, I'm not reading too much into the 4 years, but I do feel much better 4 years in than I did on day one. And I think I'm smart. I think I'm thoughtful. I think I'm a quick learner. And I think, I've seen how the portfolio behaves in a lot of different economic conditions so far, even though it's only been short 4 years. We've had trade wars, we've had tapering cycles, we've had pandemics, and now we have World War III about to start. And so I've seen how it behaves. And more importantly, not only how the portfolio behaves, but how I behave as the portfolio manager in those periods of, economic uncertainty and market volatility. Because, if you pick the best stocks, but you sell them when the market's down and you buy them when the market's up, it doesn't matter that you picked the best stocks. So I think it's a lot of behavioral, analytical, lots of different edges, hopefully combined into one to make a good portfolio manager.
So just to kind of go off of that, since starting OneMain, what are some things that you've really learned about yourself or learned about your strategy that have really been important to you?
Yeah. In terms of the strategy, I've learned the things that matter most to me about a specific investment. When I look for an investment, I typically look for businesses that are, predictable. I like them to play in rational and growing end markets with good unit economics. I like them to be well run and well capitalized. It's very important for me to have management teams that I think are smart, capable, and aligned with me. I want them to have strong balance sheets so that they could use that intellect and alignment to make good decisions for me and other shareholders in periods of economic and market volatility, whether it's acquisitions or investing heavily into new products or services or taking market share. And then I want the valuation obviously to have a large margin of safety, so that if I'm right, we make high IRRs, and if I'm wrong, we make low IRRs, but not negative IRRs. That's kind of what I look for. And very early on, I always looked for all those characteristics, but very early on, the first year or so, I definitely weighted valuation, for example, more than I weighted maybe management quality or maybe balance sheet quality. And, I think over time, I've made, the progression that a lot of investors kind of make throughout their career, or at least successful ones, I think do. We all have to learn for ourselves, by touching the stove when it's hot, even though people tell us not to touch it. And I definitely value, management quality and balance sheet quality, for example, more now than I did, on day one. And that means I'm willing to pay up a little bit more, right? As I think about the terminal multiple that I'm willing to ascribe to any business I'm invested in, I typically, think about where the S&P trades. So the S&P right now is, around 20 times, probably 19 times, 2022 earnings. And I think, that's about in the range where it's been historically. And if I'm buying a business that I think has higher returns and slightly faster terminal growth, and is a higher quality business than the average business in the S&P, maybe I'll go a few turns above the S&P, 2, 3, 4 turns above the S&P's multiple in my terminal year. And for businesses that are slightly lower quality and, maybe slightly lower growth and lower returns on capital, and less predictable, more volatile, maybe I'll go a few turns below the S&P's multiple. And what that means is I valuing the quality and the management quality and the balance sheet quality has kind of pushed me towards businesses where I'm willing to ascribe a higher terminal value. So there's definitely more risk of being wrong on the multiple on those. But the nice thing about those is that they tend to grow their earnings per share and free cash flow per share at higher rates. And so if you're wrong on the terminal multiple, it's just a matter of time before that growth kind of bails you out, right? If something should trade at 18 and I'm ascribing it a 20 times earnings multiple, then, and it's growing at, 10% a year, which hopefully the businesses I'm buying are growing their free cash flow per share faster than that. It takes you 1 year to kind of grow your earnings to break even on that multiple compression. And so businesses that have faster earnings per share growth and free cash flow per share growth, I think, are more likely to generate positive returns as long as you're able to hold on to them for, a good period of time. So that's the biggest change I would say I've made, and my biggest learning about myself.
Gotcha. And going back to the portfolio and idiosyncratic bets, just after following you over the years, I think your portfolio is idiosyncratic. Like, you look at lots of different types of companies. So I'd like you to just speak to that. And I really admire that you don't just hone in on one industry or something. So yeah, just talk to that if you would.
Yeah, thanks. I think investing is not just a job for me, it's a hobby. I enjoy studying lots of different types of businesses, which helps. And then, I think it's healthy to have a portfolio that has lots of different types of businesses in it. So you're not kind of tied to any one specific factor, like I said, or, any one type of economic growth factor or interest rate factor or anything like that. But most importantly, I'm not building a partnership that I'm trying to market where I feel the need to be bucketed or siloed for LPs and allocators, right? I'm building a strategy that the people who want to join for the ride, that's who my loyalty lies with. And I want to generate the best risk-adjusted performance I can for them over the next 30 years of my investing career. I don't just want to do it for them. I also want to do it for slightly selfish reasons. I'm competitive. I want to have the best track record I could possibly have. And so what that means is I'm not going to throw things out of my investment universe just because they might not look good or they might not fit in someone's bucket. Of course, there are types of investments I won't make for my own personal reasons, but they won't be for anyone else, and they won't be because I'm trying to, look a certain way for someone. So, all things considered, if I find similar expected returns for a portfolio of businesses that are very large, very diversified, very low cost of capital, right? If I found a portfolio of businesses that are all in mega cap land with very attractive IRRs, I'll go there because I'm not trying to pitch myself as a small cap fund. And mega caps tend to have the most diversified customer bases, the least supplier concentration, the lowest cost of capital, the best balance sheets. And if I find, really good returns with small caps or mid caps, I'll go there. But I understand that I need higher IRRs to justify moving down, the market cap or the business quality spectrum. And so I'm just trying to kind of balance, the best IRRs I could find with the narrowest range of outcomes in my mind for those IRRs, where if there is a wide range of outcomes, it's more towards the right tail than the left tail, right? So I'm looking for high IRRs without meaningful customer concentration, without meaningful litigation risk, without bad management teams, without a lot of leverage, financial leverage, right? Financial leverage can cause companies to have to sell divisions, fire employees, and pull back in periods where they should be leaning into the business. I don't like that. They have to miss out on M&A opportunities. So I just think of all those different risks. I force rank, everything in the portfolio every day in terms of expected IRRs, as well as the watch list. I think about the range of outcomes for those IRRs, and hopefully I'm skewed more towards the right tail than the left tail. And and that's how the portfolio is kind of built up, and it ends up where it ends up. But it's not intentional that it's all over the place. There will be periods potentially over the next 30 years where, it's very heavily tilted towards one sector or heavily tilted towards one market cap size. But if I'm tilted towards a sector, a market cap size, or something like that, it's going to be a very calculated bet, hopefully, where I'm aware that I'm leaning into that specific type of bet for a very specific reason. And not just a function of me trying to get bucketed into a certain type of fund or strategy or something like that.
Do you put guardrails on that? So, I can't be over X percentage in this sector, like you're saying, or it's pretty fluid?
No, I haven't put formal guardrails on it. I am cognizant of not uh, unnecessarily taking on that risk unless I'm really being paid for it, unless I want to take on that risk. A great example is our largest position today, and it has been for a while, is KKR. It's an alternative asset manager. It's around 15, maybe slightly larger percent of assets. I love the sector. I love Blackstone as well. There's some other alternative asset managers I really like. But it's much harder for me to find a home for a Blackstone in my portfolio because I'm already so exposed to KKR. And while I think they're both going to work over the next 3 to 5 years, they're kind of highly correlated to each other. So for me to increase my exposure to that specific bucket, I would need much higher IRRs than kind of the base case IRR that most of the portfolio has. There's no specific guardrails. If I made that bet, the one thing I would probably do is just be very upfront with my LPs that I was making that bet, so they could make the decision on whether they wanted to stick around for that bet or not. Right. The last thing I want to do is surprise someone with a bet where they think, I'm running the strategy the way I have been for the last 4 years, and now I deviate from that slightly for a very specific reason potentially, but they should know, because a lot of people who become LPs because they've been following me for a long time and think they have a good sense of how I kind of build the portfolio. And if that changes, I feel like that's the only thing I would do. But I'll never say I won't ever be heavily tilted towards one sector or something like that. It just hasn't been the case so far.
Yeah, that makes sense. And then to dig in a little bit to how you're calculating IRR, like over what period are you doing that? It's like 5, 10 years.
Yeah. So every name on my watch list and in the portfolio, I typically build a 5-year model for. I look out normally to 5 years. Sometimes if I think something could play out more quickly, I'll look out maybe 3 years. But most businesses, I model out 5 years. I apply a terminal multiple to that number 5 years out. I look at the cash generation between now and then and assume either they deploy that into M&A or buybacks or build it up on the balance sheet. And then I apply a terminal multiple to the earnings, and then add back any net cash potentially that they've generated if I haven't modeled them deploying it. And then I look at what I think the stock would trade for that 5 years out. I compare it to where the stock is trading today. I look at the IRR of that, and I force rank that across every position in the portfolio and the watch list every day. I mean, I have a spreadsheet that automatically calculates it in real time. So, if I put something on and I think it's a 3-year double or a 5-year triple or even more, and it moves up 20% immediately, but I'm really confident about the business quality and management and all that stuff, it doesn't mean I'm going to like blow out of the position by any means, but I'm cognizant of the fact that the risk reward has changed in that environment for sure. And so, I'll trim to positions, I'll add to positions on the margin. I'm not going to get out of them entirely if something, if the IRR goes down a little bit, but to put something on, I'm looking for 25% plus gross IRRs. And then if it starts dipping way below 20 because it's working really fast without a commensurate increase in my price target, then maybe I'll probably be close to out or very small in it at that point. And normally things that will be a 15% position, we're looking well into the 30s in terms of IRRs that I'm expecting from them. So that's how I think about it.
Yeah, super clear. And then one other thing I'm interested in is like going back to you look at a lot of different stuff. So I'm curious about your process for like either looking at a new industry and then saying, okay, that's part of my circle of competence now. Like, what does that process look like? Like, how much work are you putting in? How do you like looking at these sectors over years and years? Or I'm just curious how you ramp up.
So there's a lot of sectors that I'm very comfortable with that I think I can get up to speed on a business relatively quickly because it's already in my circle of competence. For those businesses, from the time I start research till the time I put on a position could be a much shorter period of time. I've been investing for over a decade professionally. Before that, I've been studying businesses for even longer than that. So I've been looking at businesses for decades. So my circle of competence, I think, is pretty big. Of course, there are names that are not necessarily in my circle of competence that I realize are high quality businesses. They might have above average growth, above average returns on capital. I just look at the stock chart over 10 or 20 years and I see it's had above average performance for 10 or 20 years. And if I don't understand those businesses, I understand that it probably is in my best interest to get to understand them better over time, even if I'm never at the point where I'm ready to pull the trigger. And so I naturally study those businesses, and it's not something where I know that if I'm studying it, it's going to make its way into the portfolio. And it doesn't need to be all at once, right? I'm not cramming for a test and studying for a test this weekend. I understand that this is information that could be used for the next 5, 10, 15, 20 years. And so like, I'll open an earnings report and read the prepared remarks. I'll see if there's any interesting Q&A, and then I'll forget about it for a week, 2 weeks, a month, till next quarter. 2 quarters from now, maybe I decided not to look at it for a quarter because I was busy with something else. And then maybe I'll open a 10K, and then maybe I'll open a research report. And, next thing you know, I've been kind of like browsing, tidbits about this business for 2 or 3 years. And maybe, at that point, I feel comfortable enough where if, I could model the business, I understand what I think it's worth over the next 5 years, 3 to 5 years. And if it hits a price that's attractive to me, maybe I could put it on. So it's not, there are situations where I'm new to a business and it's kind of like a sprint to get to the finish line because I think the valuation is really attractive. And there are situations where it's, more of a marathon where I don't know if it's ever going to make its way into the portfolio, but I think it's in my best interest to understand the business so that if it ever gets to a price where it makes sense, I'm ready to act. So that, those are kind of the 2 main ways I get to know a business and expand my circle of competence over time.
That's awesome. Do you find, just curious, do you find that, like if valuation's good and you're sprinting to get up to speed, that those generally turn out better, or the ones where you've, just been browsing for years?
I think the ones I understand better tend to work better usually.
Yeah. So, I would love to talk about KKR a little bit. Like I've never personally looked at it. Just give us an overview of sector and why you really like KKR.
Yeah. So, KKR is an alternative asset manager. It's one of the, the leaders in the space, along with Blackstone, Apollo, Brookfield, Carlyle, TPG, a lot of these big ones, but KKR is one of the bigger ones of the group. The alternative asset management space includes funds that manage private equity strategies, private real estate strategies, infrastructure, private credit, growth equity. And, there's been a really interesting trend over the last few decades where pensions and endowments have realized that in order to kind of meet their liabilities, they can't have all their assets invested in 0% fixed income or 1% fixed income or 2% fixed income. They need to kind of realize higher returns. And, one of the strategies they've kind of started thinking about is allocating more of their fixed income portfolios into these riskier strategies. And, they've done that through alternative asset management. They haven't done that as much through public equities. I think there's a few appeals of the alternative asset management industry. For one, you don't get daily marks, so it's easier to stomach there's real actual volatility in every underlying business. But when you don't get daily marks, it's easier internally to just kind of be blind to the fact that volatility exists. On top of that, the alternative asset management industry, as far as active management goes, has actually done better than active management in public markets for a variety of reasons over time. For one, I think in private equity specifically, you have the benefit of non-recourse leverage on your underlying companies, and leverage increases returns, assuming returns are positive. You also have better alignment between shareholders and management because private equity tends to control the boards of the businesses they're invested in, and they make sure that the management teams don't steal from the companies. They don't make empire building acquisitions with low returns. They're very sophisticated professional boards that are focused on shareholder returns. They also, private equity, they tend to put more capital to work in periods of uncertainty and volatility because they have a lot of dry powder. A lot of public equity managers panic sell their stocks at the lows and lock in their losses forever. And so I think private equity has justified its fees historically better than public equity, with lower marked volatility and a ton of capacity, right? I mean, they need to move a lot of money over from fixed income towards these riskier strategies, and private equity, infrastructure, real estate has a lot of capacity. You could invest billions and billions and billions of dollars in these strategies, where if you just wanted to shift billions and billions and billions of dollars to some kind of mid-cap strategy that, had assets that were similar to a lot of these private names, you probably wouldn't be able to do it as effectively without buying indices. And then you just kind of own high quality and low quality and businesses that have good management and bad management. And so, I think allocators have made the decision they want to move money to these alternative strategies. They need to move so much that they have to write big checks. And the only funds that have proven the ability to accept big checks and deploy them effectively are the handful that I named earlier. And so, the broader industry is growing double digits. The big guys have taken market share. So you kind of have an end market that's growing double digits with the big guys growing faster than the end market, and they're not competing on price, to get that growth, right? It's a rational, competitive oligopoly with very high returns on capital, because they need to put up zero capital basically. I mean, they put up a very small percent of the capital, and the LPs put up a very big percent of the capital, and they get to keep not only the fees, which are like 60 to 70% margin type revenues, but they also get to keep a percent of the carry. And then they also, reinvest some of their own earnings back into these deals and make a return on that as well. And so you have these secular growth businesses that trade at very reasonable, valuations. I bought KKR at 10 times owner's earnings. It trades at around 12 times owner's earnings today, but the stock is up 3x from where I bought it. So, the multiple went up by about 20%, but the stock tripled. And that's mainly through earnings growth, earnings per share growth. And I think that, if I look out 3, 4, 5 years, I think it's probably going to triple again. I think the same drivers that drove the tripling in owners' earnings over my hold period, I think are intact. I think they're durable. I think they're scalable, right? It's not like they've fully penetrated their market in any way. And so I think they'll probably triple again over the next handful of years. I think the stock is probably worthy of a higher multiple if they continue to prove that they're growing at these rates. And so we can get the benefit of not only the tripling of earnings power, but a potential, maybe doubling of the multiple, maybe 50% increase in the multiple. And that's how you get a 5-bagger or a 6-bagger. And so I think the range of outcomes are pretty narrow for this one. A vast majority of the value of the business lies in the fee revenue. That's long-term, predictable, contracted revenue. I think the downside, if I'm wrong, is pretty low. I struggle to see a scenario where I don't make a positive IRR. It's just a question of whether I'm making, the 30% plus I think I'm going to make, or whether I'm making 5 or 10% IRRs. The management team is incredible. The balance sheet of the alternative asset management company itself is incredibly strong. They're able to play offense. During COVID, they were able to go out and make some acquisitions, not just in their funds, but actually on the corporate level as well, because they have such a strong balance sheet. And I think we're very aligned. They want to see the stock go up. A lot of the investment professionals have a very big chunk of their net worth in KKR stock. They're actually mandated to maintain a certain amount of stock in the business. And so those are the situations I look for, right? Predictable, growing end markets, rational competitive set, high returns on capital, strong management team, strong balance sheet, reasonable valuations. And if you're able to construct a portfolio of those types of investments that are uncorrelated to each other, I think over time you should probably do pretty well. So, and for KKR specifically, I'll just touch on one more thing, is that for this market environment, there's, some things I've been trying to avoid in the portfolio, just because, I do have a macro view, but I think about every name from a bottoms up perspective. But I think from a macro perspective, I've been trying to avoid names that have excess exposure to global supply chains, because I think we're going to be supply constrained from a distribution standpoint for a while. I think we're pretty backed up, right? Containers, and there's lots of companies that have to air freight stuff or can't even get stuff cost effectively to where they need it. So they're pulling back production. Auto companies are a good example. They cannot produce cars right now because they don't have chips and they don't have parts. So I've been trying to avoid companies that have too much exposure to supply chains. KKR has none of that. Some of its portfolio companies might, but its portfolio is pretty diversified, and the actual company itself doesn't have too much exposure to it. And then I've been trying to avoid, too much exposure to entry level labor, because their bargaining power has continued to increase over the last year or two, and they're demanding higher wages, rightfully so. I'm happy they're getting higher wages. I think it's earned and deserved. But there's lots of companies out there that are not used to operating in that type of environment. And, them seeing wages go up from 10 to 12 to 14 to 16 on, for minimum wage or entry level labor, is hard for them to pass that increase on to their customers. So that could lead to margin compression. And also, when the entry level employees have more bargaining power, they tend to move jobs more often. And so there's a lot more turnover. And when you have experienced employees leaving and new employees coming in, it's less productive. So not only do you have lower margins, but you're able to produce a smaller amount of goods and services, just because your training staff, they're not producing at the same level that the prior staff was producing at. So you could, in theory, have lower revenues with lower margins. That's really bad for earnings. And so, KKR has neither of those. They have very expensive employees, but they've been used to operating in a competitive labor market for decades. Nothing has really changed for them. It's competitive now. It's been competitive for decades. This is the environment under which they were built to operate under. And so, it just kind of checks a lot of boxes. They do have exposure to interest rates because they do use leverage in the underlying investments. But I think the market kind of overestimates the risk of higher interest rates to their business. Private equity really started proliferating as an investment strategy in the 70s, when rates were significantly higher than where they are now. And usually when a private equity firm is buying a company, or when a real estate private equity firm is buying a piece of real estate, they're bidding against other financial buyers. Typically if there's a strategic buyer, they're going to win that auction, right? So typically if you're winning an auction as a private equity buyer, you're bidding against other financial bidders. And everyone under a higher rate environment is just going to lower their bids, because they're all trying to get the same IRRs. And so you're going to put capital to work at lower entry valuations in a higher interest rate environment. And so I still think you're going to get your targeted IRRs through lower entry valuations, instead of paying higher entry valuations with lower interest rates. So I think they've proven they could operate in that environment. People get nervous and skittish every time the market goes down and interest rates go up. So they kind of tend to struggle in those environments. But if you look at 3 to 5 years, I think the business range of outcomes is pretty narrow. And so, I think the valuation's right and the growth profile is right for it to be a big position.
Yeah, thanks for breaking that down. So I'm curious about the general breakdown in terms of how much of the business is private equity versus real estate versus other stuff.
Yeah, so for KKR, private equity is still a vast majority of the business. In terms of fees, revenues, assets, they've grown a few areas of the business pretty meaningfully over the last decade or two, but there's still a lot of growth to be had in those segments, and that's what's driving a big chunk of their above market growth. Specifically, they've had a real estate business that's gone from like 0 to 30 or 40 billion of assets over like a decade. They've had an infrastructure business that's gone from 0 to like 30 or 40 billion in like a decade. They've had an Asia, geographically kind of focused business in Asia that's gone from 0 to similar numbers in like a decade. And so they've been kind of seeding and scaling a bunch of new focus areas for the business that have each gone from like 0 to like 30, 20, 30, 40, 50 billion. And they still think that those could end up being much, much larger over time. If you look at Blackstone's real estate business is significantly larger than KKR's today. And they fully expect to be, a number 1, 2, or 3 player in every business they play in. So like you look at those numbers that Blackstone is putting up, I think KKR is thinking that they will eventually, become maybe not number 1. I think it's pretty far gone in terms of Blackstone taking the number 1 real estate business, but they should be able to be number 2, number 3, maybe number 4, and that means a lot of growth. In terms of actual assets, their credit business has grown a ton as well. It's a lower fee business, so in terms of revenue, it's the contribution's been a little less material than some of those other ones. But they still have a very long runway. But private equity is still the biggest driver of the business today. It should be for a long time, but those other businesses are quickly catching up. Over my ownership period, I think KKR's AUM has gone up from, fee paying AUM has gone up from, maybe 150, 200 billion to, it's approaching 400 plus billion now. And I think that there's no reason it's not going to be $1 trillion, asset manager over the next handful of years. And it could eventually be multi-trillion, right? I mean, if you just think about global equity markets, that's around 100 trillion. If you think about, global real estate markets, that's another few hundred trillion, 200-300 trillion. Infrastructure, add an infrastructure, you're looking at a total TAM. You throw in credit as well, moving credit from, public fixed income towards private credit. And, you're looking into the many hundreds of trillions, if not, I don't even know what the number above, 1,000, I don't know what 1,000 trillion is, but these markets are massive, and there's no reason why someone like KKR can't have 1, 2, 3 trillion over time. And so it just, that takes you till the end of the decade pretty easily in terms of growth.
Wow. So 400 billion in assets. How much, like, what is the general fee structure for private equity? Like, is it pretty similar to public equity, or what is the fees? I'm sure it varies by strategy.
It totally varies. The blended average rate is around 1% fees or something like that.
Gotcha. No, super interesting. So private equity is still like the majority, like over 50%.
I don't remember the exact percentage, but I think it's probably over 50% of their fee revenue. Yeah.
And then is carry like 10%, 20%? It varies a lot.
So of earnings, it's lower. If you think about carry, it's very cyclical, right? In periods where the market's strong, you might have a lot of carry. In periods where the market's weak, you might not have as much carry. But if you look at it on kind of a through cycle, on an average, 3-year average, 5-year average basis, the revenue should be pretty similar to the fee revenue. If you just look at average carry, the margins are much lower. So, fee revenues, they might pay 30%, 35% of that fee revenue to investment professionals and employees. The carry they pay, maybe 60% to the employees. So the carry, makes their cost structure much more variable. When they do well for LPs, the employees make more. When they don't do well for LPs, the employees make less. And so their margins, their overall profits are much more stable than the carry would imply. The other thing I'll say about carry is that there's lots of investment professionals who put a lower multiple on carry because it's a more volatile earning stream. I don't think that's a fair exercise, because, you should look at an average year of carry, but over time, carry should kind of grow in line with AUM, just like fees grow in line with AUM. If carry does not grow in line with AUM, that means you're not investing the capital well, and that means you're not going to generate good returns, which means you're not going to raise new funds, which means the fees are going to be less valuable because they're eventually going to decline as well if you can't raise new funds. And so if you believe some asset manager is a good asset manager and they invest well, then over time, through cycle, carry should grow in line with fees. And so for that, and it's similarly high returns on capital, because you get that carry without having to put up much of your own capital as well. And so it's secularly growing, high return on capital. I think they deserve a similar multiple in my mind, as long as you're looking at on a normalized carry year and not on an intra-year carry year. And so that's just my view. Everyone values businesses the way they see fit, and the market price at the end of the day is the weighted average view of everyone's kind of valuation. But that's how I think about carry.
Yeah, makes sense. So how many funds is KKR raising per year? Like, how often are they actually raising money?
Yeah, I think they're going to raise like 30 different for 30 different strategies this year or something like that. Last year they also raised for a lot of strategies, but they had two strategies that were, two of their larger strategies going to market. So it led to, a very high year in terms of assets raised. I think they raised over 100 billion of fresh capital last year. This year, those big strategies are not raising again. They raise every few years, not every year. So, they'll probably raise, I don't know, 50, 60 billion, maybe 70 billion this year, fresh capital. They also return some capital to their LPs every year. So their AUM doesn't grow purely by new fundraising. It's fundraising less capital returns. But if they're at, 350 billion of fee paying AUM, there's no reason they shouldn't be able to grow by, 35, 40, 50 billion of net AUM growth this year. And I think that should only accelerate in years ahead. But it's pretty diversified across a lot of strategies. Like I said, there's some chunkier ones, but the nice thing is those chunkier, strategies have been de-risked at least for the next 4 years because they just did their big fundraisers and they were very successful fundraisers.
So what do you see as some of the bigger risks for the business model?
Performance. Yeah, I mean, it's just if they put up, a string of bad performance, I think, for a few years it's not a big deal. But if you raise a fund and it doesn't perform well, and then you raise another fund off the goodwill from your prior funds, not based off this past fund's performance, but based on the goodwill from the prior ones, and then that one doesn't do well, I think you're probably going to be hard pressed to raise, newer, bigger funds in the future. So, there are some really big names in the space that 5 years ago had reputations and brand names on par with KKR that have kind of degraded a little bit. But even those funds, by the way, are still raising tons of money, which shows you how strong this tailwind is into the space. But that's something I follow closely just to see how the various funds are performing, and and try to see if any key investment professionals are leaving. There's always, some key partners that leave because they want to start their own funds with their name on the door. Maybe they already made enough money where they just don't want to stress anymore. But just making sure you don't see mass turnover, mass changes. So I think the people business, that's the biggest risk. And then the other one is, I think there's some regulatory risk, right? There's every once in a while you see a headline from some politicians who hate private equity because they kill jobs and they over-lever companies. And, I think from a regulatory standpoint, there's not a very high probability that legislation passes that kills the industry, but it's something to monitor. And that's an example of a reason that I would demand a much higher, expected IRR to be massively overweight that specific industry, because there is the chance that you wake up one day and something's proposed and that people decide that it has a high chance of getting approved, and maybe it does have a high chance of getting approved, and you should get paid for owning that risk if you're going to own it inside. So those are the key risks I think about.
Gotcha. So, I mean, KKR raising 30, 40 strategies, what does it actually look like for like how they create the teams around those? Are people on various strategies, like in terms of the employees, or are they bringing in outside people to manage the strategies? I'm just curious about what the internal culture is like for that.
Yeah, they have specific investment teams for each strategy. They have marketing and IR team for the overall firm that helps fundraising for those strategies, and they bring in the key investment professionals from those specific strategies into the meetings, with the IR teams to talk to LPs and explain the strategies and try to market them. But the nice thing is that they a lot of these strategies that they've seeded have had a lot of continuity in terms of investment professionals and returns, and they've gone very quickly from strategies that are managing a few $100 million to tens of billions, and the same number of people who were running the few $100 million are now running the tens of billions. Maybe they grow the headcount a little bit, but not nearly as much as AUM or fees, and so that's where you get the massive operating leverage in the business. So a business that's growing top line 10% with those types of incremental margins should be able to grow its operating profit well in excess of 10%. And then on a per share basis, even faster, because they can use the cash they're generating to buy back stock or make acquisitions, because they don't need to reinvest their earnings back into the business to generate that growth. So, 10% top line, 13, 14, 15, 16, 17% operating profit growth. You decide how much operating leverage you think they can deliver, plus buybacks and acquisitions. Like you could, very well be into the 20s in terms of EPS growth. And I think you could do that for a very long period of time, and you're buying it at a multiple that's way below the market multiple. I just don't think that makes sense. And if I'm wrong on it, and maybe it does make sense, and the stock compounds at 10% from here, but I don't think that's likely. But I like having that type of return profile where if the business does what I think it should do, we can make 20% without multiple expansion, and maybe 30% with a more fair multiple. And if and if I'm wrong, I still think I might make a double-digit IRR. So I like those situations.
Yeah, I mean, I think that's a great example going through your strategy, all the things you're looking for, and then also super helpful breakdown of private equity and alternative asset managers. So appreciate that. So I want to be respectful of your time. The closing question I have for guests is, are there any daily habits that have led to your success?
I think reading. I like reading. I have genuine curiosity about the world. So I don't just read about investing. I read about politics. I read about behavioral psychology. I read about successful people, not just in business, but just in other areas of life. And I think genuine curiosity about other people. So I like talking to people. I feel like I have empathy. I could put myself in other people's shoes, understand their incentives, understand what drives and motivates them. And so I think having conversations with people and trying to be able to put yourself in their shoes are kind of helpful to investing over time. So yeah, that's what I would say.
Awesome. Well, thanks for a great conversation and appreciate your time.
Awesome. Thank you.